Do you need me to introduce you, Kirsty?
Can do, if you like.
Those who don't know, if you've got a question on pensions, Kirsty knows everything.
Go on.
Well, knows is pretty good, and from DBs to all the technical stuff which goes along with pensions. They're great vehicles, but they just get more and more and more complicated. There was a chap called Steve B about 15 years ago doing seminars about how complicated on A Day in 2006, saying it's mad, it can't get any more complicated than it is today, and it just gets more complicated. And anyway,
pension simplification.
You almost have to live it, don't you? You almost have to have the experience to know what it was before, to know exactly how to do it today. Yeah. Plus how everybody else interprets the rules. Anyway, so I hand you over to Kirsty.
Hey, morning everyone. As I say, if you could just be on mute for the presentation, and if you have a question, then come off mute, just so we can avoid any background noise. So this is a pension and investment technical session. So it's designed for those advising on investments, tax, inheritance, and capital growth in mind. So say any questions as we go along, please feel free to butt in, or obviously leave them till the end of the session. The learning objectives for the session are to understand the options available to IFAs when helping clients to invest efficiently and profitably with tax, inheritance, and capital growth in mind. There will be certificates available if anybody wants them for CPD as well, so just email us at the end after and we can get those over to you. So a brief agenda is just to go through carry forward, including an example which I'm sure you'll all love, lifetime allowance, and then the family investment company versus trusts for IHT planning, which is where Charlie will come in. So we're going to start with carry forward. So this was introduced in the tax year 2011-2012 alongside the first reduction in annual allowance. Carry forward is essentially a potential way to increase the annual allowance for an individual in the tax year in which the contribution is being made. An individual can use unused relief in the previous 3 tax years, but can't go beyond the date of first joining a pension scheme. Carry forward is only possible where the pension contribution exceeds the annual allowance, whether that's standard or tapered. And for any person who's actually already triggered the money purchase annual allowance, carry forward is not available at all. So we have pension input periods, and these are all now aligned to tax years as of the 6th of April 2016. And prior to that, individuals had their own individual PIPs until the transitional period of the tax year 2015-16. Anyone who is eligible can carry forward any unused allowances from a tax year in which they were a member of or joined a UK registered pension scheme. It's a very broad rule, and a member basically includes any active, so those currently building up benefits in a pension scheme, deferred members, so where they have a paid up fund or a right to a pension scheme, and it doesn't actually matter how long ago they became deferred, how long ago they left service, and even if they actually paid any individual contributions themselves. Pensioners, so those receiving payments from a pension scheme, or any pensioner credit members where a member has received a pension credit following a divorce, so that will count as well. Some eligibility points to note. So someone receiving annuity may be considered a member, but it depends on how the policy is set up. So it's written in the name of the scheme trustees, so i.e. a scheme pension written in the name of the member as a deferred annuity always seems to be fine, but it always seemed to be a query over lifetime annuities that were written in the name of the individual, as technically it wouldn't be a registered pension scheme. It's however widely thought that HMRC had no intention for this type of annuitant to be treated any differently. So it's just thought that they can use carry forward, but obviously no increase if they've obviously got a drawdown plan and have triggered the MPAA. Where a client was not a member of a registered pension scheme, but was a member of a non-UK pension scheme, it's important to find out whether or not they satisfy the definition of a currently relieved member of a currently relieved non-UK pension scheme. And if they do, these are also eligible to use carry forward. Any rebate-only pensions are eligible for carry forward. And the important notes to remember are that there's no need to have had a PIP ending in the tax year, or for any contributions or accrual in that tax year, or to have had relevant earnings in the tax year, or to in fact have been living in the UK in that tax year. So in practice, where the annual allowance is exceeded, it's the unused allowance from the earliest year that's used first. So if you're looking to maximise carry forward, you'd go back 3 years, but not beyond the date of first joining a pension scheme, before the current tax year. And if there is an annual allowance excess in any of those years, you might actually need to go back further to check the contributions and to uncover where the unused annual allowance had been used previously. So in fact, in theory, you may even need to go back to 2008, 2009, dependent on what's happened in the past. So I wanted to run through an example. It's probably relatively complicated, and I'm sorry, but I can't really help it. So you've got Jane, she runs her own company and she's got a SIP that receives employer contributions. In the 2021-22 tax year, the employer will be paying £30,000. However, Jane would like to pay in an additional £20,000 as a personal contribution. She has the earnings to support it, and it won't be affected by the tapered annual allowance. However, if you look at the table, and you can see that there is unused allowance in 2018-19 and 2019-20, there was actually a £60,000 payment in 2020-21, which actually would have used all the year's allowances and would have needed to carry forward to cover the excess. But when looking at what can be carried forward into 2020-21, you actually need to look back. And this is where I was saying in the earlier slide about going back 3 years from when that additional annual allowance had been used. So therefore, you'd need to go back to 2017-18. And the £20,000 unused allowance in this year would then be carried forward to 2020-21, and therefore completely clear the excess payment in that year. So this then leaves the unused allowances in 2018-19 and 2019-20 available to be carried forward to the current tax year. So when Jane pays her £20,000 in this tax year, the first £10,000 will use up the remaining allowance for the tax year, and then the £5,000 from 2018-19 will be brought forward first, and then £5,000 of the £15,000 that's unused in 2019-20 would follow. So she would actually then be left with £10,000 of unused allowance still remaining from 2019-20 that could be used next tax year in 2022-23. Finally, on carry forward, some points to remember. It's important to remember that annual allowance is separate to a client's tax relievable contributions, and a client is therefore limited to 100% of earnings, and carry forward cannot apply if the annual allowance is not exceeded due to there being insufficient net relevant earnings. In relation to taxation, bit of a repeat of the above at the bottom, but employer contributions are subject to the usual wholly and exclusively test based on the period in which they are paid, and personal contributions are limited to 100% of the individual's relevant UK earnings. If contributions were solely being paid by the individual, carry forward could not be used unless their earnings in the current year were greater than the annual allowance. So that ends and completes carry forward, and we're now going to move on to lifetime allowance. And I do apologise for the sheer amount of information in these slides, but it obviously gets a little bit complicated. The lifetime allowance.
Kirsty, so just to be clear on that, you can only contribute up to 40,000 in any 1 year if you've got earnings of 40,000. If
you've got the earnings, so if you only earned 30,000, you could only contribute 30,000, so you couldn't use carry forward because you couldn't possibly contribute the full annual allowance or more because your earnings weren't sufficient.
You could, but you'd be taxed on it.
Yes, well, yes. Yeah, sorry, Paul. I knew you'd get me with a technicality. The lifetime allowance is an individual limit on the amount that can be taken from a pension scheme without a lifetime allowance charge being applied. So the current lifetime allowance is £1,073,100, and that was fixed in the March 2021 budget until 2026. The lifetime allowance is tested at a benefit crystallisation event, or BCE, and so that means that the date of pension coming into payment, death before age 75, reaching age 75, or any transfer to QROPS. There are protections available, and we will cover these in this session. The values used for the calculations of the lifetime allowance are the purchase price, it's an annuity, the amount of funds designated to income drawdown for an income drawdown plan, or 20 times the initial income level for a scheme pension, or the total amount of the pension commencement lump sum. Any pensions in payment prior to A Day, so the 6th of April 2006, are only valued at the first BCE post A Day. So where an individual has no uncrystallised funds, the pre-A Day pension will never be tested. Where a BCE occurs, the pension income is valued at 25 times the yearly pension income. There are different ways in which some products are treated, and for the purposes of this session, I've kept them to calculations that would occur going forward rather than those that have occurred in the past. So for any post-A Day BCEs that have already occurred, pre-A Day pensions will have already been taken into account, and full details should be available on the total lifetime allowance percentage used, usually with a certificate that the member will hold. Where no BCE has occurred since A Day, the details are 25 times the annual income of an annuity, 25 times 80% of the maximum annual income allowed under a capped drawdown, or 25 times 80% of the maximum annual income that could have been paid under capped drawdown for a flexible drawdown pre-A Day plan when that is.
Yeah, I know. It's because I was trying to get a discount code for the NHS, but then it got too complicated.
Could I ask you to mute,
Too slow,
please?
so.
There's nobody there. I thought I heard them in the door.
No. Bonzo. That looks so frightened.
Hang on, I should be able to mute it somehow.
Yeah,
How do I? Have I got control, Kirsty, or?
you should be able to mute, I would have thought. I don't know. No, there we go. Brilliant, thank you.
There's always one.
So lifetime allowance is tested on death, but only before age 75, and only on uncrystallised funds. And the values are tested when paid out within 2 years of the scheme administrator being aware, or could reasonably have been expected to have been aware of the death of the member. In the event that it's paid out after the 2-year period, there's no lifetime allowance test, but the lump sum will be taxed at the recipient's highest marginal rate, or a straight 45% if it's paid to a trust. It's important to note that had the benefits been paid within the 2 years, there would have been no income tax liability as the member died prior to age 75. With DC funds, the value that is tested is either the lump sum paid out, the annuity purchase price, or the amount designated to drawdown. And for DB, it's the amount paid as a lump sum only, because the scheme pension itself is not tested. The timings, did I not move that on? Sorry. The timings used differ whether there is one BCE or more. Regardless of this, however, the value used for the amount to be tested is at the date the BCE occurs. So where there's more than one BCE, all of them assume the same date, but the value is at the BCE date and tested against a lifetime allowance at the date of death. If there's only one BCE, then the value is the BCE date, and the same date is used for the lifetime allowance as well. So there are 13 BCEs where lifetime allowance will be tested. We're not going to run through each one individually, but there are some that are worth being aware of and raised in this session. So BCE 3 is applicable where there is an excessive increase to a scheme pension. So that's where the pension is increased at any point over both the threshold annual rate and the permitted margins. Threshold annual rate is where the increase is more than the higher of RPI £250 or 5%, and the 5% is unless anything else has been agreed by the scheme administrator. Where the threshold annual rate is breached, the pension is tested against the permitted margin, which is the ongoing cost of living since the pension came into payment. And the annual rate of increase again is the higher of RPI or 5%. There's an exemption to cover schemes with 50 or more members, where there are at least 20 pensioners in a group receiving the same increase. It's the only BCE that can be tested post age 75. And it's something to consider if you find yourself advising a client on something referred to as pension increase exchange, or PI, where they're being offered a one-off increase to their pension in exchange for increases that aren't required by legislation. So, for example, a member may be offered a one-off increase to their pre-97 pension income for foregoing inflationary increases that are not required. So they'd be foregoing it for a level pension. BCE 4 is another one to be aware of. So for annuity purchase from uncrystallised funds, it's simply the value of the purchase price of the annuity, and BCE 6 will cover the lump sum. but where the annuity purchases from drawdown will be the difference between the annuity purchase price and the original amount designated to drawdown. There are some elements of pensions that aren't tested against the lifetime allowance. So these are pre-A day pensions. These are taken into account on the first BCE post-A day. And where there are no uncrystallised funds post-A day, they'll never be considered. Triviality from a DB pension scheme, although you will need some available lifetime allowance in order to qualify for this. Small pots lump sum, unauthorised payments, dependent scheme pension, state pension, payments from unregistered schemes, and paying a pension from an overseas scheme unless UK tax relief has been claimed on the contributions. The lifetime allowance tax charge is applied at the first BCE where the lifetime allowance is exceeded, and then on any future crystallisations. So if a client chooses to take their pension benefits in stages, each BCE uses up some lifetime allowance, so the charge only applies when the lifetime allowance is exceeded. The chargeable amount is the amount crystallised over the lifetime allowance. If benefits are taken as a lump sum, 55% is deducted before it's paid out. This must be before age 75 and where scheme rules allow. If the excess is taken as a pension income, 25% is deducted on the amount withdrawn. The individual will also be subject to income tax on the income. So for a higher rate taxpayer, this equates to a 55% charge with a 25% lifetime allowance charge and a 40% income tax rate. If a transfer to QROPS takes place, an immediate charge of 25% is applied. So the liability for the charge is different between if it falls during an individual's lifetime or on their death. Where it occurs during an individual's lifetime, the individual and the scheme administrator are equally liable, although in practice, the scheme generally tends to pay. If the scheme fails to pay the charge as they've acted on incomplete or inaccurate information and can prove they acted in good faith, the liability will then fall to the individual. The individual is responsible for completing a self-assessment return, showing the excess benefits taken, how they were taken, along with the amount of tax paid by the scheme. The scheme administrator will provide this information to the individual and no further liability should be due. Where the charge occurs on an individual's death, it's the recipient that's actually liable for the charge. The scheme administrator will pay the amount out in full, and the personal representatives of the deceased are responsible for finding out if a chargeable amount is due, and they must inform HMRC. HMRC will assess the beneficiaries, and where there are multiple beneficiaries, the amount should be allocated fairly so that the charge is spread proportionately between them. So there were various protections that have been available to individuals either currently or previously, and these can be grouped as A-day protection in the form of enhanced and primary, and protection from decreases in the lifetime allowance as fixed and individual protection. There were two types of protection that could be applied for at A-day, enhanced protection and primary protection. Anyone could apply for enhanced protection, but no further relevant benefit accrual should occur. So for a DC pension, this meant no further contributions from the 6th of April 2006. DB was naturally more complicated and related to the amount that could be transferred to a DC scheme, and a limit was applied on what could be paid based on a revalued A-day benefit. If relevant benefit accrual occurs, protection is immediately lost and the standard lifetime allowance would apply. Individuals with over £1.5 million in value at the 5th of April 2006 were able to apply for primary protection. An enhancement factor is applied to the standard lifetime allowance. Looking at an example of an individual with £2 million pension value at the 5th of April 2006, they would receive an enhancement factor of 33.33%, which is the difference between the value and the lifetime allowance at A-day. The individual will therefore receive 133.33% of the standard lifetime allowance, or £1.8 million from the 6th of April 2012, where it's higher. And the deadline to apply for these, obviously in the past, at 5th of April 2009. So after this, protections from decreases in the lifetime allowance were introduced. The lifetime allowance was at its highest in the tax year 2010-11 at £1.8 million, and it's actually decreased on 3 occasions since then, with CPI increases being applied from 2018-19. And as I said earlier, in the March 2021 budget, the lifetime allowance is going to remain at its current level until 2026. On each occasion that the lifetime allowance was decreased, HMRC introduced a new protection. So we have fixed protection 12, FP14, IP14, FP16 and IP16. So fixed protection 2012, or FP12 was the first one introduced on 6th of April 2012, when the decrease was from £1.8 million to £1.5 million. So it allowed individuals to lock into that £1.8 million lifetime allowance if they applied by the 5th of April 2012. And for this to apply, it had to have no further benefit accrual from the 6th of April 2012. Next was fixed protection 2014. And so that allowed individuals to lock into the £1.5 million lifetime allowance rather than suffering the decrease down to 1.25 million. And again, they had to apply by the 5th of April 2014, and there had to be no relevant benefit accrual from the 6th of April of that year. Individual protection, it was the first time that this was introduced in 2014, and this was for individuals who had benefits held over £1.25 million as at the 5th of April 2014, including any benefits in payment. The value of the protection was based on the value of the individual's pension benefits as at the 5th of April 2014 and capped at £1.5 million. The value of the protection is a fixed amount and doesn't increase, and any benefits above the protected value will be affected by the lifetime allowance charge. And the application deadline for that.
Okay. About most of those already.
Could you please go on mute? Application deadline for that was the 5th of April 2017. And lastly, we've got the current protections of where there is currently no deadline. So we've got fixed protection 2016, which allowed individuals to lock into the £1.25 million lifetime allowance. And again, no benefit accrual allowed from the 6th of April 2016. And individual protection, also again, still currently no deadline on that one. And for total benefits over £1 million as at the 5th of April 2016, including benefits in payment. And the value of protection was based on the value of the individual's pension benefits as at the 5th of April 2016 and capped at £1.25 million. Again, the protection doesn't increase and benefits above the protected value are affected by the charge. It's possible to receive an enhancement to the lifetime allowance outside of protection, but they are limited in nature. So this occurs for a pension credit on divorce, where the ex-spouse's pension has already been tested against the lifetime allowance. Benefits from a recognised overseas pension have been transferred into a UK registered pension. Contributions have been made or benefits accrued in a UK registered pension scheme for an overseas individual, and no UK tax relief is available. A factor is calculated in the year in which the event occurs and applied in the year in which the BCE occurs. And lastly, there is the potential for the lifetime allowance to be restricted. Some individuals had a protected pension age prior to 6th of April 2006, and it was possible to retain this subject to certain criteria being met. Those with minimum pension ages below age 50 tended to be those with special occupations, such as professional footballers. And if the protected minimum age is between 50 and 55, there's no reduction in the lifetime allowance. If the minimum protected age is below 50, there is a reduction of 2.5% of the lifetime allowance for each complete year below the current minimum pension age when tested. So, for example, if a professional footballer retires in this current tax year, so 21-22, at the age of 40, the lifetime allowance will be reduced by 14 complete years at 2.5% per year, and that would result in a restricted lifetime allowance of £697,515. And that's everything on carry forward and lifetime allowance. We had originally intended on putting something in on SAS, which we haven't done. Is it anything that anybody would be interested in discussing either now or at a later stage?
I must say, Kirsty, I'm just listening to that. I mean, pensions, they are just extraordinarily complicated. And you can't help but wonder if how it's all progressed. In the 90s, you know, people like me were out selling pensions saying, well, it's tax-free. And what a long way from it's tax-free have we. It's not tax-free at all. First of all, we had Gordon Brown, and then you know, a lot of these limits, you're getting double. It's worse than tax neutral. It's let alone tax free. You're getting taxed twice. It is remarkably.
And they want everybody to put it into nest, Charlie.
That's right.
But one area where there is SaaSes are quite interesting. The old traditional industrial estate where small engineering firms own, or mechanics own their own unit and have it inside the SaaS. They are quite interesting. So if anyone is keen, please, on a seminar on SaaSes. A lot of it's non-regulated as well, so we don't see that much of it coming across our desks. But I fear that it's becoming just for the older IFAs who understand it. But anyway, if anyone does want, we'll do those.
Yep, I would.
There you go, Kirsty. We've got another seminar.
Yes, please.
On one anyway. Right, do I need to take over control, Kirsty?
Yes, I need.
I was going, am I mute? No.
Yeah, we can hear you, Andrew.
Andrew, okay, good. I just thought, as a point of interest, I've got a lady just coming up to 75, and she's James Hay, with James Hay. And James Hay don't think it's their job to apply for protection to which she's entitled. James Hay are taking the view it's my job as the advisor. Well, that's fine, we can do it, but there's lots of people might have thought James Hay would have done it.
Why we don't use James Hay.
That's the answer. Yeah, they won't. James Hay don't take a responsibility for a lot.
Right. Okay. Just thought I'd mention it. Okay.
Right. Well, if you're ready to go, I'll do the second half. Look at that, Kirsty. It's bang on 10:30.
Oh,
timing.
perfect.
So the idea is this takes us home for the remainder of the hour. So family investment companies against trusts, and the family investment companies are sort of slowly making headwind. The Inland Revenue recently started to investigate them. In fact, closed the book on the investigation, saying, "Well,
do they, Charlie?
Well, we don't see that there's any reason to go further into investigating them." So, so to speak, their alarm bells are ringing that a lot of high net worth people are setting up family investment companies, and a lot of high net worth accountancy firms are advising on them. The problem with trusts is, as you're probably all familiar, they can be extremely complicated. You need accountants, lawyers, and to do tax returns and so on. And to a certain extent, that's why the insurance industry invented insurance bonds, which don't produce an income, so that you don't need a tax return, you don't need an accountant. But the bonds themselves are extremely complicated and complex, and you only need to look at some of the rulings and of people who have tried to cash them in and got it wrong by cashing one unit instead of equally across the board, or vice versa, and being hit with large gains. There's also problems with trusts where you have settler issues. So taxes go pinging back to the settler, and the settler always has this, there is a settler involved in a trust. I don't think you can have a trust without a settler. So, and there is liability which goes back to them in various legislation. Now, tax complicated, as I've said. Discretionary trusts, which are the sort of holy grail for people to give away their assets but retain some element of control. They have a 10-year tax, which again is complex to calculate. And over the years, time and again, more and more antitrust tax legislation keeps coming in. So personally, I've struggled. The transfers into trusts above the nil rate band triggers an immediate inheritance tax charge. It's not simply a pet, so that's an issue. And administratively complex. And you only have to look at the number of names for a trust. I mean, you think a trust is a trust, you have bare trust, absolute trust, interest in possession trust, accumulation and maintenance trust, discretionary trusts, investment powers, and so on. A lot of them are the same thing, actually, but the industry delights in complication of the terms, and it makes it quite hard to figure out what's going on sometimes. So the family investment company is becoming more and more of a growth area. I've mentioned this second bullet point. In August last year, they closed its specialist family investment company investigation unit after finding no evidence of abuse. And really, they're done under simply a private company. It should be attractive to a lot of you on this call, because a lot of you, not all of you, but run your own limited companies, and so you at least have some idea from running it yourself as to how a company works. You know, there's shareholders, there's directors, and there's employees. You should have some idea that you can have a set of articles. You can really say what you like and update the articles as often as you like. You can have alphabet shares, meaning A, B, C, D, and child A or child B, and they have different shares. So you award a dividend to any particular shareholding class, so therefore to the one particular child.
So, Charlie, I've been told the alphabet shares are really looked badly by HMRC now, and you're going to get into trouble with them.
But it's within the legislation, and if it's within their right to close it, and they haven't. I mean, we're not proposing to do anything edgy. I mean, they may not like it, but if it's there, you can do it. You can have voting and non-voting shares. I'll come on to that in a bit more detail. And you can also loan share certificates. And what I'm trying to get to is the holy grail, which is to give away the assets but retain control. And a lot of parents and grandparents, what are they worried about? They're worried about their children getting divorced and so on, and the son-in-law they don't like or is after the money, or so they're worried about these things. And so if they use a family investment company, they can, in this case, the bullet points, they can subscribe for shares, they can provide loans into the company and get the interest back again. They can transfer the value but retain control. You can use voting shares, non-voting shares, lending share certificates, as I've mentioned before, and of course director control. So they could be the one and only director of the business, or two directors of the limited company, and therefore retain control that way. It's all set in relatively straightforward legislation, the Companies Act, and which is a lot easier to navigate than trust legislation. And most of you, as I say, if you're running your own businesses, you should be familiar with it. Obviously, you've got corporation tax. Obviously, capital gains tax is slightly better because it's taxed at corporation tax rates, not at the 28% rate for tax. And don't forget, with discretionary trusts, there's a higher rate above that. And the dividends that flow through once you've set you've set the company up, you've bought the shares underneath, the dividends that flow through, if they flow through to the shareholders, there's no extra tax to those. If paid out as dividends to the shareholders, there's no extra tax. So that's the point, the first bullet point. The second bullet point, you still retain your £2,000 exemption each year, each person. And there's no, if you're not a taxpayer, there's no children, there's no further liability to pay. So those are the tax rates in that slide. Moving on, this is a graphical example of how it would work. So you've got the person at the top, and who's giving away the assets. So they're setting up a company, and somehow or other they're putting just a shell company, and somehow or other they just need to put assets, the money, into that company. And all of you as IFAs are quite entrepreneurial enough to be able to, and you've got enough wits to be able to work this through, that they could contribute money into that limited company. They can either subscribe for shares themselves, or they can lend the money to the children who could subscribe for shares themselves. So those are two key ways where they've given away assets. Yes, it's a pet, but there's no immediate tax charge as there is under trusts, and there's no settler issues. And for instance, if they loan it in, again, that there's they can get the money back. You know, we're all familiar with gift and loan trusts, but I would hazard to say it's a lot simpler within a limited company, just to gift the money in and take the capital back, but leave the growth within the limited company. So the mechanics of that are not especially complicated. You should really all be familiar with it. You know, you've got share certificates and loan agreements, and if you want to lend share certificates, if you just going back a slide, you could the 4 children in this example could own the shares, but in the same signing ceremony, you know, they can lend the shares back to the grandparent who's just given them the money. And so if they've lent the shares to the grandparent, the grandparent has the share certificates. And with the share certificates come voting rights, and they've only loaned them, but they've got the right to vote. So therefore, they can't be voted out of control, and the money is already passed down because the owners of the share certificates are the next generation down. I think I've covered this. Inside the trust, there's settler issues, the nil rate ban, the inheritance tax, the excess over is charged, whereas in the company it's simply a pet. So you're looking at a 7-year life insurance policy, decreasing term to cover the potential liability for tax. So step 1, gift your 200,000 to the next generation using a pet. Step 2, next generation invests that into the company shares, maybe with Alphabet shares. Step 3, they lend the shares back again to the grandparent or the parent, and with the loan comes the voting rights. Or you simply give the children non-voting shares. Why not? There is an element of control about the company and transfer of assets and so on, if the voting shares can be valued differently to the non-voting shares, which is valid, but the difference I would say is not massive. And so equally, you could the Alphabet shares could simply be non-voting shares. So in that case, the grandparent would retain control. The parent can remain the sole director. Effectively, directors run businesses. And yes, the children could call their loans back for their share certificates. Point 1, using a lawyer probably. Yes, they could vote the director off the board. Point 2. And yes, they could therefore run off with the money, and the grandparent or the parent no longer has control. But I'd say that's quite a extreme example, and there's a lot in there. They'd need a lawyer. There's a lot of play in there, and I'd say it needs a fairly catastrophic breakdown to get to that situation. So the parent has retained control, which is my central point, and but has also transferred the wealth. So that's key. No problems with the divorce of the child or the difficult child who's spending the money unwisely. If you Google, there's lots of stuff in legal websites and accountancy websites, and generally speaking, it strikes me they make it unnecessarily complex, forever delving into the most complicated scenarios. And it's a relatively straightforward concept, and I'm keen to encourage you all to look at what is essentially quite common sense and simple. In essence, you've got voting and non-voting shares. Yes, you can use preference shares, but you will capital and interest on loans. You will understand that if you're paying interest on a loan, fine, there's tax to be deducted, but the capital itself is refunded. It's a fairly simple thing, and you can get once the money's inside the company, if they want to borrow money to gear up to invest in more shares, the company will get tax relief on that, which is something an individual can't do. So having created a share portfolio, if they want to borrow 20% more, they'll get tax relief on the interest for the 20% more. Any questions so far? I'm on the home straight, I do believe, in record time. So what have you got to do? You've got to register the company. That's something relatively straightforward on Companies House. You've got to create the articles. You can get model articles. There's plenty of, I think we keep several copies on the back document library. And essentially, if you understand them, that they're make sure you understand them, and you're in. And I don't. Yes, you could get a lawyer to draw them up for you. I don't particularly see the need. The key bit is the rights of the individual shares. So I guess that needs a bit of attention, depending on if you wanted to give voting and non-voting shares. You need share certificates. You can the company can create those from a template. You need a loan agreement, which isn't especially complicated. I loan to you and I accept the loan and a few terms with it. I don't necessarily see you need a lawyer involved in that. High net worth, perhaps it's nice to bring in the family lawyer or the family accountant, but it's a relatively straightforward thing. You need an agreement for the gift. If the grandparents gifting it down a generation, and then that generation is subscribing for the shares, that's how you would do it. If the grandparent is simply, or the parent is just simply subscribing for shares, it's just simply a share issue. Create a shareholder resolutions and keep a minute book. Then they're relatively straightforward. And most of you will have or should have come across all of this stuff on your own limited companies, for those of you who run your own limited companies. So you need common sense, but you will avoid the complexity of trusts, and for better or for worse. And hopefully, in my opinion, you avoid insurance bonds, which can be very complicated too. Here's the example again of the potentially exempt transfer going down a generation, and the next generation subscribing for the shares. Whoop, second last slide, the penultimate slide. When you come to what should you want to liquid, parents have died or grandparents have died, the next generation is in control, and they say, well, actually we'll cut it and go our separate ways. You can liquidate the company, and until recently you could liquidate it at a 10% tax charge. But the capital, if there's capital gains, if the share portfolio is doubled from $1 million to 2 million, so there's £1 million of gain, you only be paying 20% capital gains. There is something I ought to mention. You won't get the individuals won't get their £12,000 capital gains exemption each year, so that will be lost. The bed and breakfasting and so on, that will be lost. You get you're on a lower tax rate because the company's paying the capital gain only at corporation tax rates, but you won't have the nil rate band exemption. There's no added tax on the dividends, as I say, when they're paid out to the individuals. And I would say that the various options, if say you're left with 4 or 2 people holding a company, brother and a sister, say, holding a company with a large short share portfolio in it, that's your family investment companies which you've set up. I would say that the splitting it up and distribution in the end it will be a lot simpler than with a trust, and for better or for worse, but I would say it's for better. And I would say particularly if you're dealing with businessmen who have made money running their own businesses, they would be much more familiar with family investment companies. So there we have it. I've reached the end of my session. Without, can I invite questions?
You just explain that dividends no tax bit.
Well, the dividends are paid through. There's no if you're they're paid through. So the company is not going to pay any extra, receives the dividend with its tax credit attached and pays it on, and so there's no added tax for the individual.
So even if it's just capital growth on investments within the company, you're paying money out to an individual and you're saying these are dividends from the company, or what? What's the distribution from the company termed as or reportable as to the individuals?
The as tax paid.
Right. Okay.
I mean, one advantage is to use, which also stays with trusts, is to use ETFs and accumulation units as opposed to distributor units, which in theory you're supposed to calculate the tax, the notional tax, dividend tax inside the accumulation units. In practice, I find it hard to believe that the majority of people do that, and they simply report the capital gain on the accumulation units.
Yeah,
as they're bought. So there we have it. So I'd try and encourage IFAs to be entrepreneurial in their approach and to at least suggest it to individuals. If you most of certainly the large Carol, you will get your slides after the session. On the chat, most of the large accountancy practices do encourage this, or at least have a position themselves as experts in family investment companies. There's an awful lot say, well, I wouldn't do this for less than 5 million, and I'm not totally sure why. I can't see any reason why this should be limited to ultra high net worth or high net worth people. I don't buy that at all. I don't see why you can't do this for somebody trying to transfer 200,000 as transferring 5 million. There's no extra administration. And like I said, I would have thought if you're a businessman, you'd be a lot more familiar with limited companies. There is one thing when you set up a company and register it. There is a box which says, "Are you? Is this a family? Is this an investment company or is it a trading company?" And I would, I believe the ticking the box saying this is just an investment company is likely to at least raise a little red dot in the Inland Revenue's offices, or a red flag. It doesn't mean it's much in itself, but it would be nice if a small amount of trade went through. It looks a bit more like an ordinary company, just like any other company.
eBay, would that do?
eBay?
Trading in eBay?
Yes, I'm not sure what how many hundreds of pounds you have to make each year to qualify as a trade. Yes, I'm sure they would look dimly at it if you stuck through. But it's within the legislation. If there's a few £100 of trade going through, is a few £100 of trade, it's a trading company. That's the answer. Good. Hi. There's one more question on the chat, which is, well, it's how do we get the CPD for this? Kirsty, have you got a ready answer?
Yeah, so just email me afterwards and I'll do certificates and get them out. Right.
Okay. Should we? Okay. Good. So we'll produce a CPD certificate for all attendees. I don't think we have a specific exam on this, do we? Inside BAT.
There isn't. No, there is a pensions technical one which covers more than just carry forward and lifetime allowance. It's everything. There is a. That was my previous presentation has now all been transferred to video, and so you can watch the hour and a half of a video before you take the test.
Good. What, you stopped the video when I came on?
No, not this one. No, the last one I did. I think it was either an hour and a half or 2 hours of pensions technical. Must have been enthralling for everybody, I'm sure.
Good. Well, unless there's any other questions, I think it's back to work for everyone.
Thank you very much, Charlie. Kirsty.
Thanks,
Charlie.
Thanks.
Thank you,
Bye.
Charlie.
Thanks,
Thank you,
Kirsty.
Kirsty.
Charlie.
Bye.
Thank you. Bye.
Bye.